The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our hour to talk taxes, and we're going to keep you up to date on everything that's happening on the new Tax Reform 2.0 and everything else in between. And I'm joined in studio this week again with Tiffany Fabian. Hey, Tiff.
Hey there, Esther. Happy Saturday.
Happy Saturday to you. And Christopher Fabian. You're related to her, right, Chris?
Yes, I am.
We're going to go to the drive-in maybe tonight. And
I'm going to go see.
Yeah, we're going to see that movie that you talked about.
Yeah. What is it? A special favor? Or
Yeah,
a simple
a
favor?
simple favor.
It sounds so good.
Yes.
I read the reviews on that. And our special guest this week is Tim Eliason. Hey, Tim.
How are you? Maybe the first to wish you National Hug Your Boss Day.
What?
Oh, wow. And if you do that, then it's considered sexual harassment.
We will
never
me
do
too.
that. That's
So.
for sure. No hugging allowed at EG Tax.
Okay. Well, I just
All
wanted
right.
to wish you that. So.
All right, 803-0930, 803-0930, star 930 on a cell phone, 1-800-616-9236 is the toll-free number. Yes, ma'am.
And I wanted to
3930
say,
is the
get your
text.
questions in because Tim's specialty among taxes is health insurance, the marketplace, and Medicare. So get your questions started and your thinking
And they can
cap on.
text us, too, right?
Yep, 3930.
3930. All right, so what we want to talk about before we get into all the health care stuff is we want to talk about what's happening in the wonderful world of taxes. But before that, we have a couple events happening in our world, right?
We do. October 13th, we have the What's the Buzz seminar, and it's at the Eastern Hills Mall, and we're going to do a live remote there. We're going to have food and information and giveaways.
But
And
the information is the most important.
Yeah, the information is the most important. We're going to have Esther there talking about tax reform. We're going to have Dennis Kitchen talking
I'm not going to talk about baking, that's for sure.
No. We're going to have Dennis Kitchen talk about ins and outs of law, basic law. We're going to have Jeff Katz there talk about, he's a lawyer too, senior planning and elder care. We're going to have Boron there talking about college planning. We're going to have Hayfleck there talking about Social Security.
Right.
And we're going to have
And then we're going to have our exchanger.
We're going to have Mr. Russ Gullo talking about real estate exchanges, and then we're going to have real estate. We're going to have real estate with Judy Jack.
And she's the number one producer for Hunt Real Estate. So if you're not sure, if you're maybe thinking about selling your house and you're really not sure, you can come and really talk to an expert because, boy, I'll tell you, the market is hot.
And then one of my favorite names to say is Ryan Ferraro will be there. Everything you wanted to know about insurance.
Right. So what's really great is it's completely, this is just information, and this is just our way of keeping people abreast of everything that would have, the broadest paintbrush on your finances. And if you're overpaying in your insurance, if you're maybe it has something to do with your credit, and so those things are all related. And of course, at EG Tax, we want to make sure that you not only pay the least amount of taxes, but we want to make sure that your finances are in shape too. So
if you want to register, go to egtax.com, click on registration. I know before the show, Tim gets the registrations to his email. He said there were 2 people that went to the website and registered. Or you can call 632-7886 and we can register you over the phone. And I know Tim and I have been working, and Chris, really hard to get the event ready. So just need to know an idea so we know how to plan accordingly.
And then we have our tax school starting too, right?
Right, if you have a sick mind like us and you want to love dissecting the government and what they're doing to us.
But it's so wonderful because if you know tax law, it really changes what you've heard all these years, because you find out that the information that you've maybe gotten from your Uncle Harry was wrong, right?
Yep. Yep. Isn't that the truth?
And this is the year to get into it because you will be an invaluable asset to friends and family because of the new tax code. And
That's
if they
right.
learn
We're
that.
going to teach you the old law and the new law. And so how do they sign up for school, Chris?
Well, again, you can go to our website at egtax.com. There's a link there for our school. You can give us a call at 632-7886, and we could get you registered over the phone, get your information, email you the information. You name
Right,
it.
so what if somebody says, oh, but I'm not good at numbers?
Well,
I mean, it's all on computer.
it's
right?
all on computers. Yep. You don't
And
have to
what
be
if
able
you're no
to
good
do.
at computers?
Well, if you're good with people, we'll work with you on
Right,
the
but
computer
the whole
side.
thing is we actually, in many ways, kind of like it if somebody's not really good at computers because we don't want them to mess up our program. And we teach you, it's like a building block. We teach you this part of the law, then we build on this part of the law, then we show you the program. Then we build on this part, then we show you the program. And so before the end of the school, you have a really good handle on tax law and you have a good handle on our computer program,
Exactly.
right.
right?
Yep.
Okay, speaking of a tax school and being and learning things, one of the things that people should be aware of is that horrible calamity that happened on the East Coast, Florence, and people may have suffered a casualty loss. So what is a casualty loss? Who would, because there could be people in Western New York that have cottages and houses on the Eastern Seaboard, right?
Right.
And they could have suffered a casualty loss. Explain what a casualty loss is and why should people pay attention to this?
Right. Well, it's a sudden or unexpected event where you lost principal we'll say, in your house. So here
Due to no fault of your own.
due to no fault of your own, and I believe a hurricane falls into that category.
Right, well,
But
it has
yeah.
to be a federally declared disaster.
And that's what I was
which
going
it
to say.
already is.
With the new tax law, the only way you can do this now is if it's a federally declared disaster area. So
Okay, so let's say that you had a house that was worth $500,000 on the shore someplace, and your insurance company says, well, you have a $50,000 deductible, but we're going to pay everything else. Do they qualify for a casualty?
if that, yeah, they would qualify, because they have a $450,000 loss.
No, but let's say the insurance company is going to give them the $450,000.
Oh,
But
they
have
still
the
have
$50,000
$50,000, sorry.
casualty.
Then
Right.
yeah, depending on what their income is, they could still qualify.
Well, and if we use last year's big hurricane season as a potential, because we won't know until somebody passes this at the end of the year. Last year, they said the entire casualty that you suffered and your floor would be part of that casualty from your insurance. They gave you all but $100, and you didn't have to itemize. They tacked it onto your itemized deductions. So if you're somebody that has property, maybe it was due to flooding or it was due to the hurricane Florence or tropical storm Florence, what should they do to prove the loss?
Start getting your estimates.
Yep. Take photos, take
Pictures.
pictures. Yep.
And get your insurance company involved. As a matter of fact, that was one of the proofs last year. Was they had like 3 levels. They would have like, if it was under 10,000, you kind of could write it out and say this is what I lost. If it was over 10,000 up to I think 20, then you had to have 2 estimates by a qualified contractor. Anything over that, you had to prove it was your insurance company had to come out and give an estimate. So that may happen again this year. But the important thing is, if you suffered a casualty or you had a decrease in and you probably don't even know yet, you're probably sitting home watching the Weather Channel like I've been watching. When you get out there, make sure you get as much information as possible to prove the loss, because it's gigantic. It can be a gigantic tax deduction.
Oh yeah, there's some people, they don't have flood insurance, and so the losses just can be staggering. I know one of my clients had a loss that I took a casualty loss because he was on Lake Ontario for the recent flooding that
And
occurred.
that was last year, right?
Yep. And as a matter of fact, he came in to see me last week because he got $50,000 because of the money that they set aside if you
Right. If
filled
you
out the
suffered
plea,
casualty,
if you
right.
suffer. So he got $50,000 and he wanted to amend his return. And I said to him, no, that's going to go an event for your 2018 return. So,
That's
but
exactly right. And the thing is, if you have this casualty loss, you can claim it on either this year or last year, correct?
Correct. Yes, as long because of the federal declared disaster.
And on 2017's return, they're going to pay you back with interest. So again, if you're somebody that suffered the loss, or maybe you got Aunt Thelma on the East Coast that suffered the loss, you can give them a call and say, let me help you, because this can save them a lot of money.
absolutely.
All right, why
Yeah.
don't we take a short break, and we'll be back on the other side with your phone calls, 8030930, 8030930, star 930 on a cell phone. I'm Esther Golias, the tax lady. See you on the other side. Hey, this is Esther Golias, the tax lady from EG Tax, and we're here to help you with your money and your taxes. And if you're getting love letters or you haven't filed, Monday's the last time you can do it if you
Corporate.
file an extension for your corporation, right?
Corporations and partnerships. Yep.
And we do them right till Monday midnight. So if you haven't filed your corporate return and you filed an extension, you can give EG Tax a call. By the way, Tiff, you better call Wentz and tell him that the barbecue season. Is almost
Tim and
over.
I talked about that.
I'm
Tim's
thinking
already
for $10. I might have him fill up my propane
Actually,
tank.
Tim has already notified them, and that
Okay.
will be fixed.
Yeah, I mean, $10 to fill up a propane tank when it's not summer is quite a deal. All right, why don't we go to the phones? We've had Mr. Bill waiting for a long time. Hi, Bill. How can we help you?
Hi, I have a grandson, and I don't claim him as far as income, but I paid for his college in 2017. I paid $4,288 for the first semester up to the 18, and then for the second semester another $36.88. So it comes about almost $8,000. Could that have given me anything back, or?
All right, so let's ask some questions. Where does your grandson live? With whom? With his mom and dad?
With his mom.
With his mom. Okay. And does mom have have a job? Is she working outside the home?
Yes,
So she claims him, correct?
she claims it.
Okay. So I have some suggestions. What would you guys say? First of all, he can't claim him or get the credit.
Right,
But
you-
what can he do?
The college credit goes to the mom.
Right.
A 529 account.
There you go. That's what I would
Yeah.
suggest. So explain what a 529 is, Tiff, and tell him how that would help him in the future.
Sure. A 529 account is money that you open up an account. It has to be, if you're a New York State resident, it has to be for New York State college, for the person that you're getting it for, grandkid or for children. And they can use it now for K through 12, but also college. And so it's a deduction, it's an adjustment to income on your New York State return, which is really good. And so then he can withdraw money and use it for college.
And then Grandpa would get the deduction for the
Yep,
529.
the 529 on your New York return.
So assuming that you do have a New York State liability, if you open up a 529 for your grandchild, and anyone listening, that you can put up to $10,000 into the 529 plan. It gives you a $10,000 subtraction from New York State income. If you're in the 6% tax bracket, it saves you $600, but that's the best you're going to do.
Yes.
And I would suggest you do that. And anybody that's paying for a dependent, for beneficiaries' education, that would be a great tax deduction.
But there's nothing you can do, unfortunately, for the money that you already paid. Mom and dad would get that college credit, or mom would get that college credit. It doesn't matter if the neighbor gave him money for college or if he got loans. Whoever claims him as a dependent is entitled to that college credit.
That's correct. But again, if he did the 529, then he'd be able to subtract that on the New York State return. But then again, mom would have to reduce the college credit by the amount of money that was funded for 529.
York.
For New
State,
York.
right?
On New York.
On New York,
Okay.
right.
I would have claimed him. Say I was claiming him this year.
Well, you really can't.
No, I mean, say I claimed him for the year of 18.
Okay, but it's really not, it doesn't work like that. Does your grandson have income?
No, well, very little. I mean,
How much income would you say that he has? What's like as part-time jobs? What do you think it came to?
less than $2,000.
Okay, all right, so then what you have to figure out is, did you give more to his total support, and you gave over $8,000, than Mom did? If that's the case, and Mom is willing to not claim him as a dependent, now it's very important that you be careful of that because of the earned income credit. Because she might be, I don't know how much Mom makes. Does she make substantial amount of money?
She makes around 40.
Okay, is there more children than just your one grandson living with her?
Yeah, she has one other son.
Okay, under the age, under college age?
Under college age, yeah, he's 10.
Okay, so you guys want to talk about what she might lose from the
Yeah,
earned
she
income
would
credit?
probably lose the earned income credit, so she would not only lose the education credit, she would also lose the earned income credit, which could be about another $2,000 to $3,000
Right.
between the federal and the state.
So you might benefit
But she would lose.
somewhat, but she's got the education credit, she's got the this brand new family credit that she'd be losing. And so even though technically you did give over 50%, it sounds like, to his support, and you'd have the right to claim him, she actually steers the deduction, and she would lose the possibility of the earned income credit, the education credit, and the family credit. So it really isn't that easy. What I'd suggest you do is maybe give us a call on Monday. We'll take a look at your return, your wife's, your daughter's return, and show you exactly who's losing
It's
what.
funny when you're doing a tax return, it's like baking a cake or putting on all the different layers, making a pie. And so you really got to peel back all
Right.
the different
It
ingredients.
isn't clear cut at all. With all
Yeah.
these credits,
Get it
it's
any-
not clear cut at all.
There because, I just figured I'd check on it,
Yeah.
like that.
Yeah, well, and we're happy to help you, but until we really look at the real numbers, and there's no charge, until we really look at the numbers, we could just be, if we just said yes, it might be good for you, but bad for you.
A lot of times in this situation, when maybe a child wants to claim the college credit, I'll sit down and run the numbers and show them what it would be for a family if the college credit goes to the son or if it goes to the mom and dad. So in your situation, you could do the same thing and run the numbers, you claiming the child or mom claiming the child, if you did indeed provide more than 50% of his support.
Chris, Tim, you got anything else to add to this?
Nope, I think you got that pretty good.
Exactly. It's always a matter of sometimes it's negotiation, but you got to understand that you got to see what the net is to the household or
Right.
the family.
Right.
Right.
Okay?
Sure.
Thanks, Mr. Bill.
Good question.
Thank you. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. And we have a text question that came in, right?
Yep. It says, regarding a Roth, I'm 71 years old. Will I have to pay taxes on this account if I take out money this year?
Well, you want to talk to them
Well,
about
since
how
he's-
long they've been in there?
Yep.
2 out of 5 years.
Since he's 71, he automatically passes the first test,
Right,
which
but
is
not maybe the second test.
right. So then, it is as long as the money's been in there over 5 years, you're golden. There would be no tax owed on any of that money you withdraw from the Roth.
But even if it weren't in there for 5 years, because that's the stipulation, you have to be over 59 and a half and have been in the account for 5 years. Remember, it's only the appreciation that would be taxable, all right? And there'd be no penalty because he's over 59 and a half. So let's say that he was taking out 10,000 and he put it in last year and the appreciation is $100. Well, it would only be the $100 that would be taxable, multiplied by his tax bracket. If he's in the 10% tax bracket, it's going to cost him $10 in taxes. So, it comes down to doing the math.
Yep.
Right?
Yep.
Right.
Yep. The gain is taxable.
All right, and all right, let's quickly go to tax reform 2.0 because they're getting ready to change the tax law again. And it's interesting. I was telling Tiff and Chris and Tim the other day that, if you give politicians enough time, they start making it more complicated again. So here's some of the things that they're looking at. They want to make the tax law changes permanent because they're set to expire in 2025. SALT, the state and local taxes that we in New York State pay really a lot of and are being penalized, is still very contentious. So that'll be interesting to see if they modify any of that. Medical deductible floor is still at 7.5% rather than 10%, so that's good. They're looking at easing who can open up a 401k plan for employers, because a 401k plan for employers can be very expensive to open up. So for their employees. So they're talking about liberalizing the restrictions on 401k plans. The other thing is and if you are somebody that did a Roth, let's say you last year put money into a Roth, you moved from a traditional into a Roth, you can still recharacterize that up till October the 15th, but this will be the last year, so you can move it back from the Roth back to a traditional and not have to pay the taxes on that. That's really important. The other thing is they're talking about getting rid of the penalty for the RMD, for the required minimum distribution. So if you have an RMD that has, if you have a pension plan or IRA qualified plan of under 50,000, and they're saying that there's no penalty for the first $7,500 that you don't withdraw. And this is something they're
that's not a law yet, though.
And it's not a law.
Yeah,
This is just
and then
what they're proposing.
I want to say in this proposal, they want to make the changes of the new tax reform permanent. How can you make it permanent when we haven't even dipped our toe in the water and seen what all the ramifications are?
You know what permanent means.
Until the next president goes in and changes
Yeah.
it.
Group comes
Yeah.
in,
Yep.
right?
Yep.
But it makes them feel better, I think. Mm-hmm. Okay. So, we're going to take a short break for the news. 8030930, 8030930, star 930 on a cell phone. I'm Esther Gilius, the tax lady. See you on the other side. All right. Frank, you must be in the mood today for a big party. I'm Esther Gilius, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. Okay, the other thing that the federal government did this week is that they, the penalty for not having health insurance for the Affordable Care Act is still in effect through 2018. However, the Trump administration made it easier for you to claim a hardship exemption so that you aren't penalized if you don't have health insurance. But Mr. Tim Eliason, he is our healthcare guru, and if you don't have health insurance or your kids don't have health insurance, or you're between, like say you're 60 and you're waiting for Medicare until you're 65 and you don't have the money and you don't want to do, this is your time to get some great information about health insurance, because EG Health Connect, our president of EG Health Connect, Tim Eliason's here in studio. And so, Tim, should people be really happy that they don't have to pay the penalty? Maybe?
Well, yes and no. I mean, for what we do with everybody, it kind of became that the penalty became irrelevant because a lot of people didn't realize what was out there for them, and things were, affordable. I hate to use that word because it's kind of an oxymoron when you talk about the Affordable Care Act, but it presents them with a lot more options. So going away, yes. But on the flip side, it's a justification for health insurance carriers to really, in essence, really jack up their rates, because they say, well, our risk pool changes because all these people are not mandated to be in the insurance. So now all of a sudden they don't have as many people buying insurance, so they don't have money in their pool. So the rates may increase for 19. So it's kind of a double-edged sword. So
yeah, but if these people don't have health insurance, it's going to be less people going to the doctors, which means less claim these insurance companies are going to have to pay out.
You would think, yes, I agree. But, when they go to justify why they're increasing rates, the things that have been coming down, it almost looks like they want to do a surcharge. So they're increasing the rate a certain amount of percentage, and then they're adding a certain percentage based on the fact that the mandate or the shared responsibility penalty is going away.
Going away. And so in 2019, for sure, people that don't want to have health insurance don't have to have it. But in 2018, there's still the penalty for failure to have health insurance. But again, like I said, this week, the Trump administration made it easier to claim the hardship exemption. And that just means I can't afford it.
Exactly.
Right? But in New York State, though, New York State is kind of like different than many other states because New York State really was behind this. The New York State of Health was really behind this, and so they've made it so that a lot of people that are on the lower income end of the spectrum can really get some great insurance for like really cheap, right?
Exactly, and it's kind of nice because there's steps. It's not a gradual thing where as you make more money or what your income is based when you go in the marketplace. It's not a gradual slope. The way that the Affordable Care Act is set up, there's very steep steps. When you go up and go down. So
I was with a client 2 days ago, and he said to me he was at a job for 25 years and he just couldn't take the stress anymore. It was in a factory, couldn't tolerate it, so he said he quit. And he got a job working at a retail place 20 hours a week, and he had no health insurance. He was like 50-some. I said, you got to go talk to Tim. And I think Tim signed him up right then and there
we took about 25 minutes, and he kept looking at me and goes, you sure this is legal?
Right,
I was selling something in the back room that I shouldn't have. And,
Tim, really tell everybody why this guy would have had a heart attack over the cost of the insurance, because the New York State of Health has this very low threshold for people that have lower income. And what do they pay per month?
They can pay $20 a month with no deductible, and they have very low copays. If you look at the plan, really the highest copay is if you're in the hospital for 1 day, 1 week, 1 month, your copay is $150 for that trip to the hospital. And prescriptions. And then if you're really feeling bold and brave and you want to go really crazy, you could spend $47 and that would get you medical, dental, and vision with almost no deductible and very, very low copays.
Wow.
So, all right, so where's the income threshold? Because it does sound like you're a snake oil salesman.
A little bit.
Because it sounds really too good to be true, But folks, this is why you pay so much taxes in New York State.
Yep.
This is it, because if you're in Florida, too bad, too sad. You're not going to get health insurance that's this inexpensive. Of course, you're not going to pay any income taxes either, which is a trade-off. But in New York State really got behind this. So.
Yep.
How much income and you get the $20 plan? If
you're an individual and your income's under $25,000 for the year, then you would qualify for this plan. If you're a couple, that number goes to $32,000, and obviously it keeps going up as your family size increases.
All right. So let's say you got 4 kids. You know what it is off the top of your head?
If you're a family of 4, it's a little under $50,000.
That. If you think about that, so let's say that mom and dad retired at 60. And maybe there's a kid in college yet, maybe 1 or 2, and your income is substantially under $50,000. They would get $20 a person, right?
And with
the kids might even get something different, right?
Yep. And it's good enough insurance that the people that I work with that, like you said earlier, that are between that age of 62 and 65, when they start looking at the Medicare plans that are out there, they're going, I don't want Medicare. I want to keep this. Yes. Can I keep that? No, I apologize. You can't. So. But, that's, it's a great bridge, for people that age. It's also a great bridge for when you have that child that turns 26, that drops off your employer plan and just starting out in the world, and maybe their job is not such that they have income or have benefits. So.
Right. But here's the thing. Tim, I can tell you, is not a snake oil salesman, and we just want to help you. And I'm going to tell you, we charge how much to do this for you.
Well, is that in the back room or in the front room?
Back room, front room.
Okay, either room, it's whatever. The same price. We charge absolutely nothing for it.
Zero. Right? Zero.
Yep.
So we just want to help, and I like I say all the time, the reason we got into this was because with the penalty, the tax return is where the penalty is assessed, and so we thought, well, gee, do we want to tell people their penalty is $2,500? Not really. So it was so great because Tim just took it upon himself to do all this investigation, became a New York State navigator, and he just is like this insurance guru, health insurance guru. So it's great. There's no charge. And if you don't have health insurance, or your kids don't have health insurance, or you're in that gap, you think you're going to just tough it out because you're 62 and you're going to wait for Medicare for 3 more years, give Tim a call because you may qualify for for what is it called?
Essential
The
plan.
essential plan. And,
Right.
and it's not just that it's an essential plan and that's the name. You know, it is provided as by carriers, you know, the ones that we're used to in the area, the Univeras, the Blue Cross Blue Shields, the Independent Health, the Fidelis, they are the ones that provide this insurance. So it's not like it's just a government insurance company called Essential. It's actually through the insurance company. So you have the
Let me
same.
ask you this. Let's say that I'm working at a retailer and I'm not making a lot of money. Let's say I'm making $22,000 a year. Okay, and they provide, and I can get health insurance through my employer. But my share of the health insurance is over 10% of what I make. Can I just kind of like reject their health insurance and go to the essential plan?
Yep, because you went over that threshold. You know, if it's above
Oh my
that
gosh.
9%,
So did you guys hear that? Over 9.5?
9.56.
Okay.
So
if you're working for an employer who is even providing you health insurance, okay, but your share of the meal ticket, so to speak, for your health insurance is over the 9.56%, you can tell the employer, keep your plan, and for $20 a month, you're going to go on the essential plan through New York State and pay no deductible.
Yep, and this is and 2019 is going to be very interesting with this, because with the increases that are coming down the pipeline of 10, 12, 15% on premiums, you know, employers have to incur that too. And all of a sudden, they maybe don't offer a plan that's really user friendly because they are now doing high deductible plans. And that's a way that they can keep the costs down for their employees. Well, you know, if you're going to be paying 3 times the amount out of each paycheck than what you could pay for the essential, you're crazy not to pursue it.
That's for sure. But see, this is
Wanna-
what's so
Mike.
scary to me. If I didn't know you, see, it's really easy because you're right just down the hall. But if I don't know you, I think, oh, gee, well, what if I change? And then I find out that I have some horrible disease 2 months later. Are they going to say, oh, I'm sorry, you saw Tim, we're not going to pay the bill? I mean,
No.
that's not the case,
No,
right?
no, by no means. You know, that's and that's where, you know, I am very specific when I sit with people, and then, you know, usually it takes a couple of visits because I want to do that inventory. I want to find out what their needs are, you know, what conditions they have, what things work best for them, and how it works too with the rest of their family, because, you know, we don't want to pursue something for one person in the family and then expose them to out-of-pocket expenses on everything else.
Right, right. All right, we've had line one has been waiting and waiting and waiting. Hi, Mike. This is Esther Gilius from EG Tax. How can we help you? You've been so patient.
Hello. I got a property tax relief check from New York State. It says, please retain this stub with your tax documents. Is that taxable income?
All right, so explain to him about his property tax relief check.
Sure. So if you itemize and you use your property taxes as an itemized deduction, you have to subtract that figure off of your allowable itemized deduction. So that relief check you got, you'd have to subtract it off your potential allowable property tax itemized deduction for 2018.
So that would be part of that SALT deduction this year when you itemize.
So if your property taxes are between your school and your county are $6,500, and you got a $300 check back from New York State, you can only claim $6,200 on your property taxes
For this
for
year.
itemized deductions.
Oh, we always get the standard deduction, so that
Well,
So
then
then
you
it-
don't have to worry.
you
Then
win.
just-
so that
Then you just
Back-
go ahead and spend that money.
well, that's good.
All right?
Relief.
That was worth the wait, right, Mike?
Thank you.
All right, thanks, Mike. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at star 930.
3930.
Oh, well, I'm close. Text us, it's 3930. We had a really nice text. Somebody said and gave us a nice compliment.
Yeah, they said, may God bless you as you give so much clear information to all of us. So.
Oh, isn't that nice?
Thank
That's
you.
Great. All right, so we're going to take a short break. We're going to be back on the other side. You have questions about health insurance? We have Tim Eliason, our health insurance guru, in studio. If you know somebody that doesn't have health insurance, give us a call, 8030930, 8030930, star 930, or any other tax question. See you on the other side.
And the party rolls on.
Yeah, but Frank got really mellow this time. All right, I'm Esther Gullius, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone. We got a full house today. We have Tiffany Fabian, Christopher Fabian, Tim Eliason, and me, Esther Gullius, here to help you. If you have any questions about health insurance, about letters you've gotten if you owe the IRS money, it's interesting. I was reading an article this week about how many seniors may end up owing money this year because of the change in the standard deduction and the personal exemptions, and that could be the case with anybody. So if you're getting less taken out of your paycheck, it really does. It's really a good idea to, I think Tiffany, your commercial said, do a mid-course look at at what you've had withheld, because there are a number of substantial changes this year, and so what they did was across the board they gave everybody extra money in their paychecks and in their pension plans, which you maybe shouldn't have gotten, and so it's just kind of negatively stockpiling, and then at the during tax time we might say to you, oh, you owe $500, and you say, but I used to get a refund.
It's so funny. I think every day I get somebody who says, I listened to that commercial and I'm calling to do that mid-course. I just did somebody the other day, Chris's client, and she called, it was yesterday, and she's going to be short, and she's like, I don't like this. And so I really wish she would have called sooner. I told her to put money into her 403B.
Yeah, they just across the board gave people extra money. Well, it makes people feel good right now.
Right.
But we're in New York State, and some of this stuff that it might be good for people in Florida is not necessarily good for people in New York State. So you just want to make sure that you just don't get that great big negative surprise when you do your tax return next year. At least now you'd have time to say, no, thank you, I don't want that extra money.
Yeah. And then one good thing in the new tax code, which benefited her, is that they have children. So instead of getting $1,000 a child for kids under the age of 17, they now get $2,000 a child, and the income phase outs are really high.
But how about people whose kids turned 17 this year?
Yeah, no personal exemption, but they get the
then they
$500.
lose $1,000, right? So it's, but they might end up with that new family credit, which is $500. But it's that's why it's almost like the Lord giveth, the Lord taketh away. You got this side that they gave you stuff, and this side they took it away. And in your situation, the balancing act may not work in your benefit. So that's part of what we want to do at EG Tax. And by the way, if you hear, if you're listening and you're would like to talk to Tim, our health insurance guru, he's at our corporate headquarters at 632-7886. You can also, you're online too, right?
Tim?
Yep. So, and they can go on there and get it. I've been, I'll meet with them just about any time. I actually met with 4 different people this morning. So Saturdays, and I'm starting to meet with people to help them out. This is the time of year you really got to take a look at things.
When is open enrollment?
Well, open enrollment for the marketplace is going to start in November, and New York always extends it farther than the federal, just like you talked earlier about. They are a little bit more gracious with the plans they offer. They also do that. So it starts in November and runs through the end of January for the marketplace. Medicare starts October 15th and runs through December 7th. And then after the first of the year for January, February, and March, there's, as they call it, a little bit of a buyer's remorse. That's a chance that if you made what you think is the wrong decision, you have a chance to make a change. So
Right. And the thing is, too, anytime there's a special situation, you can always change your health insurance.
Yes, and there's a lot of those. And, there's a lot of different rules. You talked about the hardships, things with people losing insurance. I met with a couple this morning that he's working for a company that is going to be bought out. He's going to get a huge stock buyout. He's like, this is the time to retire. Well, his wife that kind of leaves her out in the cold because they won't cover her with the retiree benefits. So we had to kind of make a plan, and they had to decide if it was a good move for him to retire with leaving her to a different health care. So
okay, let's go to the phones, and we're going to go to Dave from Lockport. And it seems like my mother loves to call me during the radio show, but I don't know why that is. But anyway, Mom, I'm doing a radio show. Okay, Dave, how can we help you?
Hi, I was late on paperwork on conversion of First Niagara Financial Group stock to the Key Corp, and I received it this year. The change was made in 2016. there was a cash settlement conversion of the stocks to Key and dividends back in 2016 and 2017. I'm wondering how I handle that. Do I have to amend 2016 and 2017, or since I received it in 2018, it appears then?
You just received the money now?
Yes.
So that would be on your 2018 return.
Right. Why did you not receive the money before this, though, Dave?
I just hadn't submitted the paperwork properly.
Okay, but they didn't, was the money available to you, and you just didn't, because isn't it correct, Chris? If the money was available to you, it would go back to the year that you should have done it. It's like holding up income.
If they cut the check back in 2017.
Right, so was that the case, Dave?
No, they didn't cut the check. I finalized the paperwork in 2018.
Okay, so then it sounds like it would be taxable in the year you received the income, unless there would be a reason that they would say, oh no, we wanted Dave to get it and he didn't get it and we sent him the paperwork and he wouldn't do it, and so that would be the only fly in the ointment that I could see.
Okay, and are there tax generally implications on the settlement portion of it? I don't understand that too much.
Well, yeah, because in effect, it was a sale of stock.
Okay.
So which is going to be a capital gain.
Okay, good.
Long-term.
Long-term capital gain. So
favorable
depending
tax.
upon what tax bracket you're in, if you're in the 15% or lower, you would pay 0% federal, be taxable in New York State, though.
Okay, good. That's very...
Okay. If you need help, give us a jingle.
Okay, thanks.
All right, thanks for
Excellent
waiting.
question.
All right, and let's go to line 2. It's Gina. Hey, Gina, how can we help you?
Oh, let me get off my phone. So I'm calling. I actually thought of another question as I was waiting.
Yeah.
My son got his first job, 16 years old, and he's been working through the summer, and I couldn't, it took a while to finally be able to see one of his pay slips, and I knew they were taking out so very little. And is that normal? Is it because it's his first job? And
Well, I mean, how much money is he making, Gina?
he's making like $11 an hour. And
Okay, but what do you think he's going to make for the year?
well, I think he's made a couple thousand so far. Is that normal? They don't take out until after you make a certain amount?
Right, because until you come to the standard deduction threshold, used to be personal exemption and standard deduction. And of course, he's being claimed on your return, so it'd be standard deduction. So until you get to that level, he's not going to pay any taxes. In the state of New York, though, once he hits $3,000, then he's going to have to pay some taxes. So yes, it's normal when somebody's making very little income that the withholding charts don't withhold it.
Right, because they look at your weekly paycheck and calculate that out by how many pays you have. And if it's enough to trigger that you would have had to file a tax return, then they would do withholding.
But I encourage that he does single zero.
Yep. And when I work with clients of ours, that's one of those things. If he's a dependent on your return, he's probably going to be okay on the federal side, not worry. But he's probably going to have a state balance due. And that's when he fills out that IT 2104 for his withholding allowance. Sometimes it's a good idea to make sure he takes a minimum dollar amount out so that he doesn't get caught short at the end of the year.
Even if it's $1 a week for New York State, parents they can't get over the fact that the kid might get a full refund for anything they withhold on the federal, but on New York State they owe $35 or $40, and they think, how can they be taxing my kid? But the standard deduction on the state of New York is very low compared to the federal.
All right, that makes sense now. And the other question is a little bit different. It's about those new tax breaks, and from my understanding, small businesses, which I guess were considered because we own 5 rental properties. They're all LLC'd separately.
Mm-hmm.
Do we get that same deduction? Because I'm understanding that it's a 20% reduction in our taxes for any.
Well, it all depends on whether your properties are operating at a gain or a loss. So when you add back your depreciation, is there a gain on the properties, or in other words, are they making money or are they losing money?
No, they're gaining.
Okay, so then as long as there is a profit, all the profits have to be netted against any other businesses that you have, and then to simplify it, it's a 20% deduction
From
of
the net.
the net profit. So if your profit was $10,000, you'd end up with a $2,000 subtraction after your standard deduction or itemized deduction.
So quite possibly.
I know what we profited last year on the 5 properties. So once they take over all our deductions and everything, whatever we netted from that, which became income to us, we got taxed on it. There will be a 20% reduction there.
Well, actually, there's going to be a modification of your depreciation that's going to increase the amount of your for this computation for the adjustment. So that's a good thing. So it might be even more than you think it is.
Oh, okay. Well, news there. Thank you so much.
And
All right.
you know what,
Thank
Esther?
you.
While we're on the topic of rentals, I went to an audit a couple of weeks ago, and they were proposing that one of my clients have their rental. They thought it was a non-for-profit, and so. Long story short, if there's people out there and they have non-for-profit rentals, if you think hard on it, no longer do you get to deduct the expenses for that non-profit rental that go on line 21 on the 2106 subject to 2%
Right,
because
let's
it's gone.
Let's make it simple. Let's say that you let's say you have a house that should have been rented for $10,000 and you just really like your friend, and so you give it to them for $2,000. So what Tiffany's saying is there was no profit motive because you should have rented it for $10,000. And you would think, well, I'll just take the expenses up to $2,000. They won't let you do that. Your $2,000 is going to be income, and where you normally before would have been able to take $2,000 in expenses and to offset it on the Schedule A, that won't be the case anymore, and so it'll just end up being income. Right?
Yep.
All right. Hey, everybody, if you need help during the week thinking about going to tax school, we can teach you all this junk. It's a lot of fun. It's an adult setting. You can get us through our website at egtax.com. But till next week, I'm Esther Golias with Tim Eliason, Tiffany Fabian, and Christopher Fabian. God bless you. Talk to you next week.